Hi, my name is Ned Koch. This is a video that I'm creating to attach to the end of this blog post, Understanding the Warp in Long-Term Treasuries, which is on the Warp Investor blog. So right now, this post is being prepared at the end of March 2026. So right now we are around here, and as you can see from this graph shows the 10-year Treasury yield minus the 3-month Treasury yield. This graph is what many finance and economics commentators call the yield curve. And as you can see from this graph, the yield curve tends to invert and then uninvert before a recession. This shaded area here, these very shaded areas here are recessions. This one, for example, is the 2008 recession. This one is the 2020 recession, the COVID recession. So it always, if you look at these at this graph, you're going to see that a recession usually follows an inversion of the yield curve and then an uninversion. And that's exactly where we are now. We actually had a quite unique type of inversion, very deep inversion in October 2022. And then we had an uninversion, and the uninversion seems to be steepening. Which means that if you look at historical data, and we have only the history to predict the future, future is unpredictable, but if you're going to use something to predict the future, past history is the best indication. So as you can see, there is an uninversion here. So a recession based on this yield curve inversion and inversion phenomenon, a recession is imminent. And we are at a time where consumer sentiment, the University of Michigan Consumer Sentiment Index is at a very low point, which tends to always precede a recession, or at least it's not a good indication. It's not a good indication of economic growth going forward, more likely an economic downturn. So in a situation like this, many people do things like shorting the market or purchasing inverse leverage funds, which are very risky ways of taking advantage of an economic downturn. A safer way, arguably, is to buy long treasuries. And you can buy long treasuries by buying, say, a long treasury fund like the VGLT. Another one that is popular is the TLT. The TLT has a higher expense ratio than the VGLT. And both of these funds, they have something called average duration. The VGLT has, in fact, the what's called the average duration is not actually the average maturity. So the average maturity of the VGLT is a little over 20 years. The average duration is a number that tells you how much the fund is likely to appreciate in value, the money you're investing, if there is a 1% increase in interest rates around that maturity of 21 years or so, or 20 years. So typically, if the central bank lowers interest rates, you see a reflection of that at the long end of the curve. So the Fed can control the short end of the curve, but that tends to be reflected at the long end of the curve. So if the Fed lowers interest rates at the short end, which usually happens in response to a recession, at the long end, there will be also a decrease in interest rates. And this particular fund, because it invests in long treasuries, is very sensitive to that 1% decrease. And actually, what you get in price appreciation is 14.1%, is the average duration. So this is why it's important to understand this number. And keep in mind that as one buys the VGLT, one gets this interest yield, which is quite reasonable right now, almost 5%. So it's a way of shorting the market that is relatively safe and that gives you a yield. So it pays an interest, which at the moment is a reasonable interest. So that's what I wanted to say about this. Thank you for watching this video.